You grab your morning coffee, slide this piece of plastic through the reader, and the machine beeps. The transaction feels complete. But that beep is an illusion. You haven't actually spent a single cent of your own money. Instead, the bank just stepped in and paid the barista on your behalf. The millisecond that purchase clears, an invisible 30-day clock begins ticking. Millions of people swipe these cards every single day, completely unaware that this ticking clock decides everything. It determines whether this piece of plastic acts as a tool to build personal wealth or a trapdoor into exponential debt. Every swipe initiates a high-stakes, short-term loan mechanism, setting the stage for two entirely different branching futures. Before that 30-day countdown can ever start, you have to convince the bank to let you play the game. You need to prove you are a reliable borrower. This visualization represents your credit score. It's the absolute metric banks use to quantify your financial track record, ranging from a low of 300 to a high of 850. Anything below 580 flags you as a risk, while a score above 740 puts you in the optimal leverage zone. That specific three-digit number dictates your credit limit. This is the maximum threshold of the bank's capital they will allow you to hold at any given time. When you first start, that limit might be around $1,000. But as you consistently pay back what you owe on time, the bank's trust in you grows, and they increase the amount you are allowed to borrow. The card in your wallet is simply the physical manifestation of an institution's mathematically quantified trust in you. Let's trace the first timeline. This is known as the grace period. You buy your groceries, the clock starts ticking, and you successfully pay back the full borrowed balance before those 30 days expire. Operating in this timeline gives you an immediate layer of security. If a thief steals your card or you accidentally buy from a scam website, the liability falls entirely on the bank's ledger. Your actual checking account remains untouched while they resolve the fraud. Banks desperately want you to swipe, so they incentivize this timeline with aggressive rewards. Every purchase can be converted into sign-up bonuses, hotel points, or even the miles needed to cover a cross-country flight. Proving your reliability in this first timeline slowly pushes your credit score higher. Eventually, that record allows banks to trust you with the multi-decade capital required to finance a car or secure a mortgage. In Timeline A, you masterfully leverage the bank's capital to secure free fraud protection, fund your travel, and build upward financial mobility. Now let's rewind the clock back to day 30. This time, we enter Timeline B. The 30 days expire, and you fail to pay the full borrowed amount, choosing to pay only the minimum or nothing at all. The exact moment the clock runs out, a core penalty activates. You are hit with late fees and an annual percentage rate, or APR, which is the mathematical cost of holding on to the bank's money. To see how this trap actually works, we have to look at this chart detailing the mechanics of compound interest. Let's start with a theoretical baseline debt of exactly $100. The bank calculates a percentage of your balance and adds it to your total. If your monthly rate is 2%, your debt is now $102. But next month, the bank calculates 2% of that new, slightly larger number. This calculation repeats constantly. The interest stacks on top of the old interest, accelerating the debt outward into an exponential curve that quickly escapes the bounds of human intuition. And if you only pay the minimum balance required each month, you lock yourself into the spiral. Those minimum payments are precisely calculated to only cover the generated interest, leaving your original purchase completely untouched. Timeline B transforms a convenient payment tool into a highly optimized automated wealth extraction machine for the financial institution. Looking at these timelines side by side reveals the tool's true nature, an agnostic mechanism of extreme leverage. To safely wield this tool, you have to follow a strict set of rules. First, always verify the APR before signing a contract, so you know the exact mathematical penalty for failure. Second, follow the utilization rule. To maximize the algorithm that controls your credit score, never spend more than 30% of your total allowable limit. This proves to the bank that you do not desperately need their capital. Third, treat your credit limit with administrative precision. Track your expenses meticulously and set up rigid automated reminders for your due dates. Finally, the absolute non-negotiable rule of the system. Always pay your exact balance in full before the 30-day window closes. Credit is a mandatory game in the modern economy. Mastering its ruthless mathematics is the only way to avoid becoming the bank's most profitable asset.